All right, hey, welcome back to Principles of Accounting 1. I was just thinking to myself earlier, it's great that we managed to find ourselves in week 9 already. The time is just cruising on by. Um, so here we are sitting in week 9, fall 2025. It gets me thinking about where we are and where we're heading. And so today we're going to talk about accounting for receivables. We'll talk about all the different types of receivables that we have in business. But I wanted to also call your attention to the classroom and just kind of highlight a couple of things. First and foremost, thank you to all of you. I'm happy to see that pretty much everyone's caught up in their work and we are making great progress. It means a lot to me. So thank you for that. I wanted to just kind of show you where we are with things. As you know, last week we had the midterm exam in Chapter 8. Very productive week, very busy week last week. And now here we are moving into week 9, talking about receivables. And for this week, we have just the Chapter 9 quiz, which makes your life hopefully a little bit easier than in prior weeks. So again, just want to say thanks. Appreciate your hard work. If you're missing anything, just make sure you get it in. I did report to the university your midterm grades. They're sitting with the registrar's office. So that's all good. We have just really a few weeks left if you think about it. 10 through 16 really. So it's what's that? About 6 weeks remaining. And it goes by quick. So just again, want to say thanks, appreciate your efforts, and let's keep up the positive momentum and don't slow down. This is the time to put the pedal to the metal. Put your foot on the gas. Just keep rolling with it, okay? But thank you all so much. Appreciate your efforts. So, without further ado, let's go ahead and get started talking about accounting for receivables. We're going to talk about the different types of receivables that we have, and we'll also talk about how we compute those receivables. And then we'll cover a couple of ratios, that type of stuff. And I'm going to give you a lot of real life examples, things that have happened to me in the past with respect to receivables, so it helps you to give you a really good understanding. As always, as we're going through the lecture, please feel free to unmute your microphone and ask your question, or you can type in the chat, or whatever works for you. I'll be happy to answer any and all questions for sure. So first, let's jump into receivables and talk about what they are. Um, now, as you know, anytime that someone owes you money or the company money, anytime that someone owes you money or the company money, that is considered a receivable to you. So anytime somebody owes you money or owes the company money, that is a receivable to you. Uh, so understanding that is really important. It helps us to better understand what a receivable is. So receivable is anytime somebody owes money to the business or to you. An account receivable represents the individual customer's account and the amount that they owe us as a business. Okay. That is an account receivable. It's an individual represents an individual customer and the amount that they owe us. If we zoom in into their account receivable, we can see a list of all of their outstanding invoices that they have not yet paid and their respective balances. Here on the screen, we can see a nice graphical representation of the amount of receivables that these four individual companies hold. Uh, this data is pretty recent as of 2024, so it's pretty relevant. We can see that out of the billions of dollars in sales that Microsoft generates each year, 48.688 million of those sales is in their accounts receivable. That represents 11.8% of all of their sales, and so it's a relatively large percentage. Next we have Nike at 4.131 million, Tesla at 3.508 million, and Intel at 3.402 million. Very, very impressive numbers. Of course, these are very large companies, but it represents the accounts receivable as a percentage of the company's total assets, which is uh, in some cases very large. Now, you might ask, is this good or bad? Should the company have such a high account receivable outstanding? It depends. It depends on the company's need for cash. Personally, for me, I like to keep this number low because what that means is that I'm collecting my payments from my customers on their account receivable on a quicker basis. So, just want to show you how we value the accounts receivables. Well, now, as we sell, our company's making sales, we oftentimes need to record that sale and how the customer is going to pay. So here we have an example of a sale that we made on account to a customer. So July 1, our company made a credit sale of $950 to our customer, and we have also collected from a different customer from a prior credit sale, also on the same day. So, uh, in this example, when we make a sale and it's on account, we debit the account receivable for that respective customer and we credit sales. Now, when we collect the account receivable, meaning 30 days later the customer is now paying, we debit cash because we're receiving cash and we credit their respective account receivable to reduce their account receivable. Remember, with accounts receivables and accounts payables, these balances go up and down, depending on what's going on. Accounts receivable balance goes up when we've made credit sales to our customers, and it goes down when those customers pay their invoice. Yep, so that's what we're seeing here. So uh, what those transactions look like as they update the ledgers. So on the left side, we can see the general ledger for accounts receivable and the respective dates. So June 30, we had a balance of 3,000. That balance went up to 3,950 after the credit sale we made, and it went down to 3,230 when we received payment from a customer. And we update their respective ledgers accordingly. I had mentioned that each individual customer has their own account receivable that's generated when we make a credit sale to them. And their balance goes up and down depending on what's going on with them. Uh, and so within your general ledger, you have your subsidiary ledgers. The subsidiary ledgers are represented by the individual customers. Now, accounts receivable is very different from when we sell and a customer pays us using a credit card or a debit card or a mobile app for payment. Uh, so not to be confused with accounts receivable. These are very, very different things. Now, a lot of companies encourage customers to use a credit card or debit card or other methods of payment like mobile apps like Apple Pay, Google Pay, PayPal, Venmo, Cash App, whatever. These methods of payment are encouraged because these shut up, Gemini. Sorry about that. So these these methods of payments, the reason why a lot of vendors encourage it is because uh, we want to broaden our customer base. We want to attract more new customers. And by offering multiple methods of payment, it is most certainly a great way to attract new customers. The other thing is that it allows customers to pay us quicker, right? If they're using a credit card, debit card, or a electronic app or mobile app. So it's good that we're offering customers to use these methods of payment, but it also has a little bit of risk involved. But overall, it's a positive thing. Just out of curiosity, for those of you on the call, I'm curious, when was the last time that you used a bank card or a credit card for making a purchase? Was it today, yesterday?
Well, I used it today, Professor.
Used it today. Okay.
Yes.
So let me ask you this, since you used it today, um, if you check your bank app, do you see that transaction listed as pending, meaning it's still in process or it's on hold, or has it posted to your account right away?
No, it's pending.
It's pending. Okay, great. Now, the reason why I asked that question is because I want you to understand why it's still pending. Now, the way that retail works is every single time a customer swipes their card with us, um, there's a couple of things happening on the back end. One is that our company gets charged a percentage as a fee for accepting the card. Okay, it's a transaction fee. It's a credit card transaction fee that every retailer has to pay, and it's based off of the percentage of the sale. Now, typically for Visa and MasterCard, that fee's somewhere around 3.5%. If it's American Express, it's about 7%. And the ones in between, like Discover or whoever else, might be somewhere in between. When it comes to mobile apps, like Apple Pay, Google Pay, Venmo, Cash App, PayPal, there's also a transaction fee involved on the retailer's side. Now, the reason why I asked about the pending part was the way it works in retail is at the end of each night, the retailer needs to close out the credit card transaction batch. And so what'll happen is once the retailer closes that batch out, it posts to the respective accounts. Otherwise, it'll maintain a pending status. Sometimes you might go to a retailer, use your card, your bank card or credit card or whatever. It'll show as pending for a couple of days. The reason for that is because the retailer has not yet closed the the batch of transactions on their end. So that's why I brought up that question and I wanted to give you some clarification on it.
And I was going to ask that why some places you go, it be pending for like 3, 4 days.
Yeah, it's just because the retailer hasn't gotten around to closing the batch, and that's really the only reason. I know
Okay.
in my opinion, it's silly, right? Because you would think that they would want to get paid quickly, but I guess some of them are just kind of lazy and don't really, or maybe they don't really need the money. I don't know. But that's a great question. But yeah, these types of options offer more options for customers. Here I have an example. July 15th, our company made a sale of $100, and it was through a credit card. Our credit card processing company charges us 4% of the total sale. And so in this case, we're going to receive $96 out of that 100. Four of those dollars is a part of that's representative in that percentage fee. So we would debit cash 96, we would debit credit card expense $4 and credit the sale for 100. So you might also notice that some retailers they try to they which is also silly and very argumentative in my opinion. Some retailers they will charge their customers this transaction fee, which is silly and stupid. And the reason why it's silly and stupid is because either way, the retailer still has to pay the 4% of the total sale price. So if they're charging you 4% more because you used your card, that's dumb on the retailer's part because it doesn't matter. Either way, they still have to pay the 4%. So if they're charging you 4% more, that means they're still paying 4% more. So that's why I don't like when I see retailers charging their customers a credit card transaction fee because either way, they still have to pay that. They dumb. They dumb when I see stuff like that. So just wanted to tell you a little bit about that side. So sometimes customers don't pay us. Drives me crazy. It happens to me once in a while in my consulting business. Sometimes I'll do the work and I'll invoice the customer. I'll send the customer the invoice, the account receivable, and I'll wait the 30 days. And once in a while, 30 days goes by, no payment. So what the heck, I get a little upset. So then I send them a past due notice and I say, hey, listen, didn't receive payment. You're past due. Pay now. Uh, Another 30 days goes by. Nothing. Okay, now I'm getting upset. 60 days. Then another 30 days goes by. Nothing. Now we're 90 days into this transaction. Then 120 days. Come on. Okay, so at this point, I figure the customer's not going to pay me. So I have to figure out a way to write off this amount that the customer is not going to pay me. And we do that in accounting in one of two ways, but we call this process a write-off. It's where we are. It's called a bad debt. Customer ain't going to pay us. It's a bad debt on the customer's part. So it means the customer's not going to pay us. So we write it off. I'm going to show you how we do that. So there's really two ways we could go about writing off a bad debt. A bad debt is when there's a probability the customer's not going to pay us. We call it a bad debt, and we can write it off in one of two ways. One is through what we call the direct write-off method, and that's very easy. We just simply debit bad debt expense and credit their account receivable. If it's kind of like this one-off type of event, we typically use the direct write-off method. The other method that we'll use is called the allowance method. This is where we estimate that a certain percentage of our customers who purchased on account or accounts receivable aren't going to pay us. So we'll estimate a certain percentage through what we call the allowance method, so allowance for doubtful accounts. So we use one of these two methods. I'm going to show you both methods. The first is the direct write-off method and probably the easiest method. This records the loss of an uncollectible account or to be determined uncollectible. So here we have the example. Our our company determines on January 23 that we will be not able to collect $520 that is owed to us by our customer. This was after probably multiple attempts of trying to get the customer to pay us. Okay. So we debit bad debt expense 520 and we credit the allowance the accounts receivable for that customer. This is to write off the uncollectible account. Now, yeah, that happens a lot in business, unfortunately, where you're gonna have a customer once in a while that's not gonna pay you, and so we could use the direct write-off method if that's the case. Now, once in a while we get lucky, and the customer magically finds their way back to us, and they magically remember that they owed us money from like 6 months ago. It happens, people fall off the radar. They vanish for 6 months and magically forgot that they owed you money. And then sometimes they make their way back to the store. So here we have an example where that same customer that we wrote off earlier back in January finds their way back to us in March. So we found the customer, demanded payment, so we reinstate their account, debit account receivable and credit bad debt expense. That's a reversing entry to reinstate their account. And then we receive the payment. So we debit cash and credit the account receivable. So that's an example where the customer comes back. So we can make an adjusting entry when that happens. So that's the direct write-off method. The direct write-off method helps us to consider our options. We expense the recognition principle. The expense recognition principle requires the expenses to be reported the same kind of period in which the sale was incurred. So what that means is that with the direct write-off method, if I made a sale in the year of 2025, by the end of 2025, I need to make a decision whether that customer's not going to pay me or not to do the direct write-off method. And also, the method requires materiality, where the constraint permits the direct write-off method as a result of approximate results of using the allowance method, which we'll talk about here shortly. Direct write-off method usually does not best match sales with expenses because sometimes we might find ourselves in the following year. So that is the direct write-off method. The more commonly used method, and the next one that we're going to talk about, is called the allowance method. Now, the allowance method or allowance for doubtful accounts is a way for us to estimate a certain percentage of our customers that will not pay us. In my business, I find that based off of the history of my business, about 3% of my total customers that have an account receivable with me, about 3% of those customers will not pay me. Okay. It's just part of doing business. There's going to be some small percentage of your credit sales that where the customer will not pay you. Okay. So we estimate that through this allowance method. Now it works pretty well. It's as you know, it's an estimate, so it has some flexibility built in. It allows us to be able to make that estimation, and any direct write-offs do not have an impact on the account, to the total accounts receivable or the net income. So these are very good things. A disadvantage of this method is that it's still an estimate, and those estimates need to be adjusted periodically. So here we have an example of using the allowance method. Our company has a total of accounts receivable sales of $300,000 during our first year of business. At the end of the first year, about $20,000 of that 300,000 is still sitting in accounts receivable. Based off of our experience, we estimate that about $1,500 of that balance will be uncollectible. So at the end of the year, we make our estimation of this 1,500. So we debit bad debt expense and we credit an account called the allowance for doubtful accounts. The allowance for doubtful accounts is considered to be a contra asset account, meaning it holds a negative balance as an asset account. We don't take it directly out of accounts receivable. We never make direct deductions like that. It's kind of similar to the way that we treat depreciation expense. This allowance for doubtful accounts is really similar to the way that accumulated depreciation works. It holds a negative balance and it's an asset account. And so I'll show you what the effect is on the balance sheet. So here we have the balance sheet, and the allowance for doubtful accounts is a credit holds a credit balance. It's a current asset, and it's contra to accounts receivable. And so the way that it presents itself is we have net accounts receivable of 18,500. The account receivable balance is actually 20,000 minus the allowance for doubtful accounts, which holds a credit balance of 1,500, giving us a total net account receivable of 18,500. So when you look at uh, a balance sheet of, let's say, a publicly traded company, uh, you'll notice that on their balance sheet, it'll either be displayed as net accounts receivable, which is net of the allowance for doubtful accounts, or it'll show accounts receivable and then allowance for doubtful accounts holding a negative balance. But I just wanted you to understand that there's two ways that we can see this on the balance sheet. So in using this allowance for doubtful accounts, we can take uh, the this using our write-off method. So our company determined that our customer owes us the 520 bucks. They're not going to pay us. So in order to write it off directly to the allowance for doubtful accounts, I can debit allowance for doubtful accounts and credit that customer. What that does is it reduces my allowance for doubtful accounts balance, and it also reduces the account receivable. It's a direct write-off to the estimate, the allowance for doubtful accounts estimate. So the write-off does not affect any type of realizable value of the accounts receivable. So what that means is that we don't directly impact the account receivable when we're using allowance for doubtful accounts. The only time it's actually impacted is when we make a real write-off or a direct write-off. So I just wanted you to understand that difference. And just as before, even using the allowance for doubtful accounts method, sometimes a customer might come back and actually pay. So we did do exactly what we did before, only this time with the allowance for doubtful accounts account in mind. So we reinstate the previously written off accounts receivable by doing a reversing entry, and then we debit cash and credit the account receivable. That's if they come back and actually pay us. Which we always hope for. We always want the customer to pay. Wind's a little heavy today. Okay, so under the direct write-off method, we don't do any adjusting entries. We just simply debit bad debt expense and credit the account receivable. It's a direct write-off. It's real simple, very direct. All right, it's real simple to use. Under the allowance method, we make adjusting entries. We estimate our bad debt expense. So we debit bad debt expense and credit the allowance for doubtful accounts for our estimate. Now we make adjusting entries as needed to write directly off to the allowance for doubtful accounts. So this slide here, I like a lot because it acts as a very nice summary slide in comparison between the direct write-off method and the allowance method. So when we make those estimates for the allowance for doubtful accounts, we can actually do this in more than one way. Now, for my business, I personally do this as a percent of sales. So I look at all of my credit sales or sales I've made on accounts receivable. I look at my past history and I make an estimate and I say, hey, 3% of my credit sales, they're not going to pay me. So that method is called the percent of sales method. And then there's the other method that a lot of other businesses use, which is called the balance sheet method, where they would take the percent of the accounts receivable and the aging report of accounts receivable. And I'm going to show you what all of these look like. So first, looking at the percent of sales method, this is the one that I use. We take the formula for it is we take the current sales, credit sales, and we multiply that by our bad debt percent. So for my company, I say that's 3%. My credit sales are usually somewhere around $100,000. So at 3%, so I figure about $3,000 will be written off as bad debt expense. Looking at another example, here we have a music store that had made credit sales of 400,000. The company estimated that about 0.6% will be uncollectible. So we take the credit sales times the percentage, giving us the bad debt expense, in this case 2,400. So we make an adjusting entry, we debit bad debt expense, and we credit the allowance for doubtful accounts. So pretty straightforward, pretty easy method to use. So the percent of the account receivable method uh, is also called the balance sheet method. And in this, we're computing the estimate for the allowance of doubtful accounts, which gives us an estimate of the bad debt expense. We take this formula is pretty straightforward. We take our year-end account receivable balance, we multiply that by our bad debt percentage. Uh, the bad debt expense, we take the total estimated bad debt expense that we got from that first part of the equation, year-end accounts receivable times bad debt percent, minus the prior balance in the allowance for doubtful accounts, if there is one. And that will be our current bad debt expense. So that's the formula. I'll give it to you an example. The music store has $50,000 in accounts receivable at the end of the year and a $200 credit balance in the allowance for doubtful accounts at the end of the year. So the company says that 5% is uncollectible. So we take the 50,000 times 5%, giving us the 2,500. We then subtract out that beginning balance of allowance for doubtful accounts, giving us 2,300. So we debit bad debt expense and credit allowance for doubtful accounts for the amount of 2,300 bucks. So very straightforward method, percent of receivables method. The other method that falls within the balance sheet area is called the aging of accounts receivable method. Your accounting information system like QuickBooks or Sage or Oracle or whatever will show you a report called the accounts receivable aging report. Now, this report shows us how old each outstanding account receivable is, how long it's been since it's been paid or was supposed to be paid. So it's classified by how long it's past due, in other words. Each age group's multiplied by the estimated bad debt percentage that is specific to the amount past due. And estimated bad debts for each groups are totaled up. So I'm going to show you what this looks like here. So here we have our music store. You can see all of our customers listed out there on the left and the respective balances. We have a couple of current customers, and we have some that are past due. So the company estimates that the current customers, about 2% of them won't pay us, or 2% of that balance will not be paid. So we can say that 2% out of that 37,000 will not pay us, which means that $740 will be uncollectible, even though those are current invoices. Now, once the invoices become past due, this is where it is more likely that the customer won't pay us. So if we look at the invoices that are 1 to 30 days past due, the total amount 6,500, we estimate that 5% of those customers will not pay at all. So that gives us bad debt expense estimation for 1 to 30 days past due of 325 bucks. 31 to 60 days past due, again, the likelihood goes up that they're not going to pay. So now we're up to 10% of those customers not going to pay. So 3,700 times 10%, that's 370. 61 to 90 days past due, this has 1,900 bucks balance. 25% of that will be uncollectible. That's 475. 90 days plus, 40% uncollectible, giving us 360 in this case. So we add up all of those categories to get our total estimated bad debt expense. In this case, 2,270 bucks. Now, once we have that amount, if there is a beginning balance in our allowance for doubtful accounts, we deduct that beginning balance. So in this case, we had a beginning balance of 200 bucks. So we deduct that from that, and that gives us $2,070 as our estimated bad debt expense. So we debit bad debt expense, credit allowance for doubtful accounts, 2,070 in this case. Now, also in some instances, we might have a debit balance already in our bad debt expense. And so if there's a balance in your bad debt expense, we would add that to our estimated bad debt expense from our aging report. So in this case, that difference would be 2,770. So of these two methods, uh, or multiple methods, if you will, um, of these three different methods, really, um, it depends really on the type of business that you have and the type of customers that you have, and the understanding that there will be a percentage of those credit customers that will not pay. If you know that a specific customer is not going to pay you back, then using the direct write-off method is probably the easiest. If we know that a, a small percentage of our past customers haven't paid us, then we can simply take that percentage and multiply that by our total credit sales to get an estimated bad debt expense. And then, of course, we can use percent of receivables or aging of receivables as well to find our estimated bad debt expenses. So this slide I like. It's a nice summary slide, and it helps us to better understand how we estimate our bad debt expense. So that is in a nutshell, what we do in the eventuality that customers won't pay us. Now I'd like to shift gears a little bit and talk about other kinds of receivables that our company has. Because, of course, as you know, we have accounts receivable, and that's usually our biggest receivable. But sometimes we might have other types of receivable. And one of those very common ones is called a note receivable. A note receivable happens when a customer hasn't paid us for some time, and we say, hey, listen, you haven't paid us in a while, so what we'd like to do is convert your accounts receivable into a note receivable. It becomes basically a loan to that customer. And as you know, with any loan, there's typically interest rate associated with it. So we're going to talk about notes receivables, how they're written out, and how we account for them. So a note receivable is a type of promissory note where there's a promise to pay, right? So as I had mentioned before, sometimes a customer might not pay us for a little while, so we'll make a deal with them, convert their account receivable into a note receivable, and say, hey, not only will you pay me what you owe me, you'll also pay interest, and it's due on this particular date. Uh, the nice thing is by converting it to a note instead of an account receivable, is that it's enforceable by law. So if the customer defaults on this note, then there is legal ramification against the customer in that case. So the note looks like this. It's going to have a date the note was made. It's going to have a dollar amount, principal balance. It's going to have when it's due, and it's going to have the interest rate stated. So this particular note that we're looking at right here is a 90-day note. Principal balance is $1,000. Interest rate's 12%. So we need to understand how much interest income or interest revenue that our company is going to earn from this note receivable. And but before we can figure out how much interest we expect to collect, we need to know exactly when this note receivable is due. So it says 90 days. It was dated July 10. Now we could compute the date of when the customer needs to pay it. It's when it's due, when the principal and interest are due, we call that the date of maturity or the maturity date. So we can just simply look at a calendar and figure out, hey, 90 days past July 10, we're looking at October 8th. Okay. Um, you can calculate that out as well. Uh, Number of days in July minus the date it was written on, uh, which gives us 21 days in July in this case, plus all the days in August, plus all the days in September, plus a few days in October gets us to 90. Once we've reached 90, we can determine what the date of that we expect payment is on. So in this case, we have the note receivable. The principal balance is $1,000. It's 90 days at a 12% interest rate. So now we know when it's due, October 8th. So now we need to be able to figure out how much interest we expect to receive on this note receivable. And the way we do that is through this formula. This is called the interest formula. And so the way that we compute it is we take the principal balance, in this case, $1,000. We multiply that by the interest rate, which is 12% or 0.12. And then we multiply that by the time. We express time a little bit differently when it comes to bank notes uh, because there are only 360 banking days in a year. There are 5 bank holidays every single year. And so we use what's called a banker's rule, and we follow 360 days, not 365. So the way we express the number of days expressed in the note, in this case 90 days, divided by 360 days in a year. So $1,000 times 0.12 times 0.25, which is 90 over 360. That tells us that we would expect to collect $30 in interest income or interest revenue from this note, from this note receivable. So there are a couple of journal entries that we need to make now that we know how much interest is owed to us and when it's due. So the first entry we need to make is we need to record the note receivable. So we would debit notes receivable and credit sales if the note receivable is based off of sales. If the note receivable was because we converted an account receivable into a note receivable, we would debit note receivable and credit the account receivable for that full amount. Now, in this case, in this example, $1,000, 90 days, 12% note, we record all of those information in the original transaction. And then when we reach October the 8th, we would debit cash $1,030. We would credit note receivable $1,000. And we would credit interest revenue $30. That recordation would happen on October the 8th, 90 days later. Here we have the other example, which I gave earlier, where a customer didn't pay us. We converted their account receivable into a note receivable. And in this particular example, the customer also decided that, hey, I owe you some $832. What they've decided to do is give us some cash up front and the rest of it be put on a note receivable. So they gave us $232 in cash and the rest of it on a note receivable, in this case $600, to represent their movement of their account receivable to a note receivable. Now this note receivable comes with it's a 60-day note. and with a 15% interest rate. And so what this means is that by the time we get to December 5th rolls around, we're going to receive that 600 bucks, but we're also going to receive 15% interest on that $600. So we would apply this that earlier interest expense equation. And so that earlier equation says we take the principal amount, in this case 600, we multiply that 600 by the interest rate, in this case 15%. So 600 times 0.15 times the amount of time, 60 over 360. And that amount will be the amount of interest that we would expect to receive on December the 5th, along with the 600 bucks. Now, when we receive it, we would debit cash, the 600 plus the amount that we collect in interest, and we would credit the note receivable 600 and credit interest revenue. Now, some instances, the customer won't even pay that. It happens from time to time. We've converted their account receivable into a note receivable because they're super past due on their account. Now we have a situation where, hey, they're not even going to honor that. So let me go through what that looks like. So this first part of the example is, yeah, that they've agreed and they're paying. Great. So just as I expressed before, December 4, debit cash 615, credit note receivable 600, credit interest revenue 15. The formula for interest is principal times the interest rate times time. Principal 600, interest rate 15 or 0.15, and the time is 60 days over 360 banking days in a year. Gives us $15 of interest. So debit cash 615, credit note receivable 600, credit interest revenue 15. Now we have a situation where, hey, the customer, we converted their note account receivable to a note receivable. They still don't pay it. We get all upset. One thing that we could do is sue the customer. The other thing we could do is convert their dishonored note back to an account receivable. So we debit the account receivable, in this case 615, credit interest revenue, and credit the note receivable. To still recognize that now the customer still owes us that 615. So that happens. That happens from time to time. Uh, at the end of each year, we need to make adjusting entries. And one of those adjusting entries that we make is in regard to interest. It could be either interest expense or interest revenue, depending on what's going on. Uh, because, as you know, we are required to follow the matching principle, which tells us that we need to match revenues and expenses when they were incurred. And here we have an example where we made a note receivable, but we didn't make it until December 16, and it's for 60 days. So what that tells me is that I need to allocate 15 days of that interest receivable to this year, not to next year, right? So to do that, we take the face value times the stated interest rate times time. Now, in this case, it's 15 days remaining in the year. So I take 15 over 360 banking days in a year, which means that I'll make an adjusting entry of $15 interest revenue. So debit interest receivable 15 and credit interest revenue 15 at the end of this first year. Now, when we move into next year, I can then account for the remaining balance of that interest I expect to receive. So here we can see that there are 31 days in December minus the 16 that were already allocated. Told us we allocated 15 days. There are 31 days in the month of January, and the rest of the time would be February. So that means that we would receive our payment from the note receivable on February 14. So on February 14, we would receive the cash payment, which includes the principal balance plus all the interest. Now we've already accounted for 15 days of the interest back in December. I need to account for January and February. Okay, so that uh, would tell me that my total. So the way to do this, simply put, would be to calculate the total interest receivable or interest revenue and subtract out the difference, which we've already accounted for in interest receivable. So to do that, we take the face value times the interest rate times time. So the 3,000 times 12% interest or 0.12 times 60 days over 360. That's a total interest revenue of $60. I've already accounted for 15 of that. So 60 minus the 15 is 45. So I receive the cash payment plus the interest revenue. So I debit cash 3,060. I credit interest revenue 45 because it's accounted for this year, not the prior year. Plus, I would credit the interest receivable 15 from the prior year. And I would credit the entire note receivable face value 3,000. So this satisfies what happens when a note receivable occurs over two different accounting periods. Now, sometimes we could receive payment from a customer before it's actually due. That happens sometimes. And also, we can sell our accounts receivable um, when we need to. I'm going to explain these concepts. So companies can convert their account receivable before they're actually due by selling them to collection agencies, or they can sell them to a bank to secure a loan. Both are possible. Okay. When a company sells their receivables, the way that it works is that they have an expectation that whatever they can't collect themselves, they're going to have a collection agency do it on their behalf. I'll give you a real life example of this. Um, Long time ago, when I was about 18 years old, I made a lot of dumb mistakes. I was just a kid. I didn't really understand how interest worked and all that jazz. Oh, I didn't learn that in high school, so nobody ever taught me that. So the first thing I did when I was 18 was I got a store card, a Macy's store card. Okay, and I thought I was a hot shot, 18 years old. I got a store card. I'm going to build my credit score with that. So I thought, right? And Macy's was dumb enough to give me, an 18-year-old kid, a $3,000 line uh, maximum on the store card. And so I, being the smart guy that I was back then, I maxed that card out. I went shopping and I did some damage. All right. So I was buying up a store. Spent 3 grand over at Macy's on the store card. All right. Maxed it out. Then I started receiving the bills in the mail. So I did what any other 18-year-old kid does who doesn't understand how payments work. I threw them out. Yeah. Get the bill in the mail, throw it out. Yeah. Real smart, right? So that's what I was doing at 18. And I thought I was being a smart guy. So by the time I got to 91 days past due, or 120 days past due in the case of Macy's, they finally sold my account receivable to a collection agency. Now, the way that that works is that Macy's would receive about maybe a third of what I owed them from the collection agency. The collection agency would go after me for the whole amount. Right? That's the way collection agencies work. So this first part on this slide here represents the sale of the account receivable to a collection agency. So here we have the account receivable total value was $20,000. The collection agency gave the company 19,200. That's nice of them, and they only required a 4% fee for it. So we debit cash 19,200, debit the fee 800 bucks, which is 4% of the 20,000, and then we credit the entire account receivable 20,000. That's what happens when a company sells the account receivable. They usually don't get that much, to be honest. It's usually much less than that. It's probably about 1/3 at best. The other thing that a company might do is they might sell their account receivable to a bank in order to take out a loan. And so when that happens, the company debits cash 35,000 in this example and credit note payable 35,000 to represent the loan. Okay. Now, the last thing I want to talk to you about tonight when it comes to receivables is as a manager, we need to be able to uh, do a couple quick computations to really understand how quickly I am collecting from my customers, um, how long it takes to collect from my customers, those types of things. And one way that I do that is through what we call an account receivable turnover ratio. And this measures how long on average it takes for us to collect from our customers. And the way that we compute this is we take our net sales and we divide that by the average account receivable. Now remember, anytime you hear the word average in accounting, we take the beginning balance plus the ending balance and we divide that by 2. That'll give us the average. And that'll give us our average account receivable turnover. So that, my friends, actually wraps us up for today's discussion on receivables. Are there any comments, questions, or concerns that you have as they relate to receivables or anything else in this class that I can help to answer for you? Anything at all? No? Y'all quiet tonight.
Not from me.
Okay. All right. Well, fantastic. Just a quick reminder of what we have to do for this Sunday night. Under week 9, which is where we currently are, we have the Chapter 9 quiz. That's the only thing that you owe me for this week. If you need any help, you have any questions, whatever it might be, feel free to reach out to me. You can email me, you can call me, we can set up a meeting, whatever you need. I'm here for you. So I just want to let you know that, and also like once again, I want to say thank you to all of you for all of your hard work in the class. It means a lot to me. Do not slow down now. Keep the momentum going. Put that pedal to the metal. Let's get this thing done. We got about 6 weeks left of this class, so let's make this a real strong photo finish. But thank you all so much for your time today. I appreciate all of you, and I hope you have a wonderful rest of your evening and a great weekend ahead. Thank you so much.
You too. Thank you, Professor.
Thank you.
Thank you,
Thank
Professor.
you.
My pleasure. Thank you all so much. Take care now. Good night.
Thank you.
Good night. Good night.